Okay. Good afternoon, everybody. Welcome to today's webinar, the title of which is Practitioners' Insights, Value Investing, Has the Alpha Gone Away? This is hosted by CFA Society India. On behalf of CFA Society India, I'd like to take a moment to welcome our audience from around the world joining us remotely. My name is Pramod. I'm a co-founder and head of sales at Marcellus Investment Managers, and I'll be your moderator for today's session. Before I introduce our speaker, I have a couple of housekeeping notes. Today's webinar is scheduled for 60 minutes, including the Q&A part. The webinar will have 3 sections with Q&A at the end of each. Feel free to submit your questions throughout the presentation. You can do so by clicking on the Q&A link at the bottom of your viewer and typing your question in the box. This webinar presentation will be available to view after the presentation concludes in the same chat box below. We value your feedback, so please do remember to complete the evaluation survey before you sign off today. Now it gives me great pleasure to introduce our speaker for today's webinar, and it's also a special subject. Our speaker is Vitali Kalesnik. Vitali is a partner and senior member of the investment team at Research Affiliates. He leads research and business strategy in the European region. Previously, he led the equity research team and continues to perform general equity-related research. Articles he has co-authored with others have been recognized with 3 Graham and Dodd Stroll Awards, a Financial Analyst Journal Reader's Choice Award, a William Sharp Indexing Achievement Award, amongst many others, including the Dodd Top Award for What is Quality. His research strengthens and expands Research Affiliates products, in particular RAFI, fundamental index strategies, and supports global tactical asset allocation products for Research Affiliates. Vitali earned his PhD in economics from the University of California, Los Angeles, where he was a winner of the UCLA Graduate Division Fellowship for 2001-2005. Welcome, Vitali. It gives me great pleasure to have you on the webinar today. Before taking too much time away, let me just set the context. I think it was your brilliant paper that you authored with your colleagues about how the death of value investing, like it's been talked about, is greatly exaggerated. You know, we all would love to hear from you in terms of why that has been exaggerated, and looking forward to quite an enriching presentation. Over to you, Vitali.
Perfect. Thank you very much for such a wonderful introduction. And so it's a great opportunity to talk to all of you today. And yes, value investing is a very important part of the investment process. There are many value managers, there are many value investors, and interestingly, in the last 13 years, value has underperformed. So this talk is based on the research, which is titled, a research article, which is titled, Reports of Value's Death May Be Greatly Exaggerated. It's available on SSRN, and there are a lot more details in the article, which I encourage you to take a look at after this webinar. So please go download it, read it, share it. There is lots of interesting, in my opinion, details there. And generally, what has made us, what has encouraged us to do this research? Well, the chart, here's the chart which shows the value performance. And the value here performance is defined as the long-short strategy, where we go 30% value companies and short 30% growth companies. So this is a long-short portfolio where we go 30% stocks with the cheapest price-to-book ratio based on price-to-book 30%, and we short 30% most expensive companies. And you can see that this strategy has been growing quite aggressively from 63 to about 06, to the end of 06. $1 would have grown to 9.5. Now, interestingly, in the last 13 plus years, it has lost half of its value. And in the March of this year, it's at 4.7. We've just recently updated the numbers through mid of this year, and the fall is even larger. And with this prolonged and deep fall in values performance, a very natural question to ask is value dead, or is it just part of normality? Of course, many pundits are saying that value is dead, and proposing a number of alternatives. Now, interestingly, so when we're talking about the narratives, very few go into examining the testable implications, and that's exactly what we'll do about these narratives. And the first one, the first narrative, here's a list of the most important narratives that we've collected. The first narrative is that maybe value just underperformed because it became a crowded trade. There is, with such a huge popularity for factor investing, value being kind of one of the most prominent factors, maybe just value just got crowded away. Well, if this is the case, then we should observe permanently narrow valuation spreads between value and growth. And I'll explain to you what I mean by that a little bit later. Well, maybe we live in a very different economic regime where FanMax type of companies or generally service-based economy is just taking over. And this transition can take decades to complete. And in this process, the old brick and mortar companies just become obsolete. The new e-commerce companies become the new winners. They're permanently more profitable, and that is driving the demise of value. Well, if this is the case, then again, we should observe that growth is just a lot more profitable than value, something that we can test. Another interesting narrative has to do with interest rates. So we've had in the last 13 years a period with record low interest rates. In many regions, interest rates were going to negative and now in negative territory. And with such low interest rates, there are certain arguments that growth can benefit a lot more. Well, we can touch upon that later, but again, something that we can test for. Maybe there is much less relative mean reversion. Maybe the market composition just became a lot more stable, and because of this, the old engine of mean reversion, where value companies migrate to growth companies migrate to value, has stopped working, and that's the reason for value's demise. Well, again, we can examine these rates of mean reversion and test it. Now, importantly, if we do find evidence for these narratives 1 through 4, what they imply is that value is structurally impaired, and investors should reconsider their allocation of capital to value or value-like strategies. Alternatively, there are a few other ones which don't have such dire predictions. So, for example, maybe value is mismeasured. What do I mean by that? Well, here, for example, in the beginning, I showed you a slide which focuses on price to book as the definition of value. But book value can ignore intangibles. And that can be a problem in the modern economy. So again, something that we can see if fixing intangibles improves performance, that would be a signal that value may be mismeasured, and we should find alternative ways of accessing value. And then finally, the sixth narrative, and you'll later see why it is very important. But the sixth narrative goes like this. Maybe value has lagged because it's become cheaper. What do I mean by that? Value, on average, trades cheaper than growth. That's the definition of value, right? So if we were to focus on 30% and 30% value and growth, the average discount is about 1 to 5 over the last close to 60 years. But this average discount has been time varying. There were periods when value was just 1/3 of valuation of growth companies. And that's when value was actually relatively expensive. And there were periods when value was trading at 1/10 of valuation of growth companies. That's when value was quite cheap. For example, during the tech bubble, it was in that range. Exactly because value versus growth discount can live in this very wide range. As value becomes more expensive, it outperforms, and as it becomes cheaper, it underperforms. And again, if we were to find that relative valuations explain the underperformance, then that would mean that we understood the past, but it doesn't mean that narrative 5 or 6 here, that value is broken. What it will mean is that value suffered from a temporary setback. So let's go more directly. And so, but to begin with, let me set a little bit of a background. Value is one of the most established factors, one of the earlier discovered, one of the most solid evidence, works across different geographies, works across different definitions, present in the most kind of accepted factor models, Fama and French, etc. Pretty much any factor model explaining cross-sectional of equity performance would have value. And what it all is saying is that value is unlikely to be just a result of data mining. Just the evidence and the background is just overwhelmingly saying that it's unlikely to be just a spurious outcome of randomness historically. And the reason why it hasn't been working recently is because just that luck just run out. But importantly, the current period of underperformance is the deepest in terms of the drawdown. Here on this table, we're showing the deepest drawdown periods, and you can see that the current one at 50% is the worst one. And it's also the longest lasting. So here we sort the worst drawdown periods by the length. At 13.3 years, it is the longest lasting. Now, the important question to ask is how exceptional is this protracted drawdown? And to answer that question, we did this statistical exercise, which is called bootstrapping. What we did was essentially took the period when we know value was working, which is pre-December 06, and resampled from that sample to create millions of historical simulation of 56 plus a few months long sample. And then we test the question, how likely are we to observe the latest drawdown given the prior history? And the answer is about 5.2nd percentile, meaning that it's not even crossing that 5% boundary. Now, it's not very unlikely, but it's far from implausible. And it needs to be kind of at 1 percentile, first percentile on the left, for us to conclude that the current period is out of the norm. Basically, what this exercise is telling us, value historically has been prone to drawdowns and prolonged periods of underperformance. The current one is nasty, but it's not out of the norms. And so with this, let me go more directly into testing with this setup. Let me go directly into testing some of these narratives. For testing, what we'll look at is we'll decompose value return into 3 components: migration, profitability, and revaluation. And I will explain to you in a second each of these components. But importantly, the first 2, migration and profitability, they jointly comprise a structural alpha. That's what keeps on driving the value premium year after year. While revaluation is the piece that can explain a lot of the short-term performance, but that's a transitory component that should average to 0 over long run. And what it captures is return due to value becoming more or less expensive. And why does it have to average to 0 over long run? Well, because essentially if it doesn't, what it means is that we're allowing for Ponzi schemes where fundamentals can be completely diverged from prices. So unless we allow for Ponzi schemes, over long run, this revaluation should average to 0. So migration, the first piece in that decomposition. So what is migration capturing? Fama and French in their 2007 paper observed that the key driver for values of performance is migration of value companies towards growth and growth companies towards value. This is what this chart is illustrating. So for example, if we have a growth company, it's the high price to book, and a value company with low price to book at time t, on average, growth company, if we were to wait for a year, would decline in its valuation, while price to book of a value company would go up. And growth company would generally underperform, and a value company would generally outperform as a result of that. Now, in a year, we'll have new growth companies and new value companies that we could select that would have gone from the middle up or down, and the cycle repeats. So basically, this migration of growth to neutral and to value, and from value to neutral and growth, is what is driving values performance, a big chunk of values performance. And here's the chart which illustrates the propensity of stocks to migration in the pre-2007 sample. Let's focus on this bottom right square. And let me explain to you what we're looking at here. So every year we're looking at each stock, and we're seeing, we're checking where does it fall into. So big means large cap, small means small cap. And then within big and small, we sort stocks into value, neutral, and growth, 30, 40, 30% as breakpoints. And if, for example, we're to look at big neutral, here is the line, which is the row, which is big growth. So big growth, the line which shows the where the stocks used to be, and then on vertical lines on the columns we are categorizing where the stocks are falling next year, and obviously we're averaging the numbers over years. So if we're looking at large cap growth, 78% companies stay in the same bucket, but then the remaining 22% are migrating out. 13% move to neutral. And then some move to small cap. As they're doing this, as they're migrating either from growth, large cap growth to neutral or to small cap, they tend to underperform. And then similarly, if we're to look at the bottom line, which is large cap value, well, here it's even less stable. 68% stay in the same bucket. And then the remaining 32% migrate out. So 24% move to neutral, and 1% moves to all the way to growth, and some move to small cap. So basically, this migration is driving value, where there is the strong propensity to move from growth to neutral and from value to neutral. That's this table characterizes the migration rates for the period when we know value was working. So what about the last 13 years? So the top chart here is displaying the chart, the same table is displaying the same table in the pre-2007 period and post-2007 period. And what you can see generally, these numbers are very, very close to each other. So if anything, for large cap value, there is even less stability. There is slightly more stability for large cap growth, but again, the numbers are looking very, very similar. So this time doesn't look too different in terms of migration. Profitability. Profitability is another component where we find that the narrative goes like this, that growth companies are more profitable and they're growing faster. So maybe this profitability is just offsetting that growth. Well, let's look at the numbers. So we've looked at ROE as the measure of profitability, and pre-2007 sample growth on average had 17% ROE, value had 6%, and importantly, the difference was 11%. Post-2007 sample, what we see is just reduction in all profitability numbers, but the numbers are very, very similar, and the difference is 12%. So 11 versus 12%. Almost negligible difference. What about sales growth? And by the way, why do we look, so growth rates? Obviously, in terms of looking at growth rates, it would be very nice to look at cash flow growth, but many of the growth companies have negative cash flows, so that's why we're looking at sales growth as a next best proxy. And so what we see is that, again, historically, growth companies had much larger growth rates, and the difference was 8%. Now, of course, the narrative today is that the growth is nothing that we've never seen before. Well, that is not true. The growth rate in the last 7 years has been 8%, which is quite a bit lower. Value growth also slower, so all of our economy is growing slower, but the difference is 6%. So there are some small difference, but the difference is, but generally the numbers pre and post 2007 are very, very similar. And which leaves us with the last component, which is revaluation. For revaluation, we're capturing this return due to change in relative valuation. We didn't invent the term. We borrowed the term from the existing literature. So Fama and French in 2002 and Arnold Bernstein 2002 have come up with this notion that if we're looking at market performance, and we're trying to estimate the equity risk premium, then we should remove the component that is coming from growth in valuations. Let me illustrate that point. So, for example, that's from kind of illustrating the history of this revaluation term. So, if we're looking at market performance, this is the blue line, and this is on the left axis, we can see that, well, those articles were written in 2002, and so obviously they're trying to examine the point around 2000, and you can see that market performance has been enormous, but also around the same time, the cyclically adjusted P ratio, which is CAPE or Shiller adjusted P ratio, has grown up quite a bit significantly. And unless you're allowing for Ponzi schemes, this great expansion in valuation should be removed from the forward-looking expectations about market risk premium. And that's what these two articles argued. Well, what we did was just expand the same argument to value. Here's the blue line, which is showing the value performance relative to growth. And that's the same blue line as what we have seen before. So started $1, went to 9.5 at point D, and dropped to 4.5 at point E. Now, the golden line here on the right axis, it is looking at relative valuations of value versus growth. So it's price to book of value portfolio divided by price to book of growth portfolio. On average, that's about 0.2. So that's about 1 to 5 discount. And you can see that this golden line is varying quite a bit. So at point B, which is the maximum of this line, it was just at 0.3, which is 1/3 valuation. And at point C and E, it is at about 1/10 valuation, so 0.1. So interestingly, when you see at blue and golden line, they're joined at the hip. They're highly correlated in the short term. So in the short term, the changes in relative valuations are the drivers of values performance. Interestingly, when we're looking at the last 13 years from point D to E, the relative valuations went from quite expensive. Here it's about 22nd most expensive percentile at point D to the cheapest percentile we have seen in history at point E. So we have not seen value as cheap as we see it today. And how much did it contribute to the strategy performance? Well, here is the decomposition, and I'll complete this slide and then I will break for Q&A, but so let me just finish this. So before before 2007, the 6.1 is the average annualized historical return. Now, in that period, in the period 63 to the end of 06, changes in relative valuations contributed very close to 0, 20 basis points. And the remainder was structural alpha, which is mostly coming from this positive migration term and somewhat negative profitability, which is strong, but much lower than migration. So as a result, when we add these two components, we get 6% structural alpha. What about the last 13 years? Well, the average underperformance was negative 5.4. That's per annum return. So that's what capitalized got us to negative 50% return. Interestingly, revaluation contributed negative 6.6% per annum. So basically, more than everything, more than all of the underperformance came from changes in revaluation. So essentially, the biggest elephant in the room has been relative valuation of value going from the 22nd most expensive to 100th cheapest percentile today, and that explains more than everything. If not this, value was supposed to be earning us positive rate of return of about 1.1% per annum. That's quite a bit lower, and we'll go after the first round of Q&A into possible reasons why, but it was supposed to be lower, was supposed to be positive, and revaluation is the key driver of underperformance. So let me just slow down here and see if there are any questions.
Thanks, Vitali. That's quite interesting. We've got a couple of questions coming in already. A reminder to our audience, feel free to enter your questions in the Q&A box below. We'll try and cover as many as possible. We'll also touch upon a couple of subjects subsequently. Vitali has slides on them as well. But for now, I think Vitali, a lot of the audience I can see is coming at, some growth investors are arguing that they're not doing anything other than value investing. It's just that their assessment of value is deep-rooted in fundamentals. Their assessment of a business suggests or gives them an edge in terms of predicting cash flows for far greater periods. And they're doing the same thing as buying the stock at a price which is significantly below its intrinsic value. How does that definition of value investing differ from what you guys at RAFI do, and how can that be incorporated into a quantitative approach?
Yeah, so I couldn't agree more that if Graham and Dodd, when they defined value in 1930s, they published a book in 1934, and where they outlined the main philosophy of value investing. And their approach to value investing was not price to book. Their approach was what you're supposed to do is do intrinsic value calculation of a company, and you should take that and compare with the market value. If the intrinsic value is lower than market value, then it's a good buy. If market value is lower than intrinsic value, it's a good buy. If intrinsic value is lower than the market value, then the stock is overpriced and is expensive. In fact, so from that perspective, that is a very reasonable value investing principle. Now, it's important though to notice that as some companies are trading at very, very high aggressive multiples, like for example, today the FanMag companies, Facebook, Amazon, Alphabet, Netflix, and Microsoft, these companies are comprising close to a quarter, let's say, of the US market by market capitalization. And with Amazon trading at P of 140, there is a very aggressive growth rate embedded in it. And that growth rate may have been reasonable when the company was much smaller, but expecting that many of these companies jointly, just very few companies jointly, will continue exhibiting the same growth rates that they used to, may be quite optimistic. And so I guess that's, and it's important when looking at the growth style of investing to still be able to contribute how much of the historical performance came from the changes of valuation and how much came from the correct evaluation of the intrinsic value. Importantly, lastly, and I will use this as an opportunity to segue into my next section then, is that when Graham and Dodd wrote about their preferred way of measuring the intrinsic value, they specifically said that book value is a very bad way of doing it. And they wrote their book in 1934, before even the glimpses of the modern economy start being important. And today, with the rise of the service economy and with the increased importance of the intangibles, that comment is becoming more and more important. Now, on the previous slide, on the slide where I ended my exposition with, by the way, Pramod, it's fine for me to continue, or
yes.
Do you have more questions? Yes.
No,
perfect.
Please carry on. We'll take the questions after your next section.
Fantastic. Book value essentially is capturing the tangible capital. And in the modern day service economy, that may be quite dangerous. Why? Because the modern way of defining accounting definitions may be quite different. Investments could be quite different from what it used to be in the 19th century. So for example, what does book value capture? Book value captures largely physical capital, cash, and other financial assets. What it ignores is patents, knowledge, brand, external network, human capital, things that we know as intangible capital. In fact, book value, essentially, if we were to start a startup today, and if we were to build a factory and buy cars and keep some cash in the bank account, that will stay, that initial capital will stay as a book value. If, however, we were to start a tech startup, were to hire a bunch of software engineers, develop a great piece of software, and then hired, started advertising campaign and distributed it. Now, what are the reasons why we're doing these expenses? Well, these are clearly investments. These are clearly investments into intangible assets. But the current accounting rules treat these expenses, these items as expenses, and they're eating out of the book value. So interestingly, if we were to capitalize the, let's say, R&D expenditure and just 1/3 of SG&A, sales general and administrative expenses, as a proxy for advertising, marketing, distribution, and other kind of management related items, what we get is that, and were to depreciate it, let's say, over the next 10 years, what we would get is that this intangible capital right now rivals the fixed capital, the tangible capital. To illustrate these points, we did exactly that, and this chart here, the blue line shows the ratio of the intangible to book value, intangible capital computed the way I just described, to book value. And you can see that the blue line is showing that number on average for an average company in the market. And you can see that currently it's around 1. So what it means is for an average company, book value misses roughly half of the average company's capital. That's a lot. Even for value company, this ratio is more than half. So that means that for an average value company, we're missing more than 1/3 of the capital. But more importantly, for growth companies, this number is close approaching 2. And so what that means is when looking at growth company, price to big misses nearly 2/3 of the company's total capital, represented by intangibles. And that's big. So when we use this, the sum of this intangible capital and the book value as a definition of value instead of book value, keeping everything else the same, we get actually a much better performing strategy. So this golden line titled IHML here, we did exactly that. We added the intangible capital with the book value, and then we computed the long-short portfolio return. It outperformed by about 50% cumulatively. Its strongest outperformance was post-80s, when intangibles started becoming more important. And it didn't have such a strong drawdown. It's recovered in around 2014, and it reached a new peak in 2016. Now, all value strategies suffered from a drawdown post 2016, but due to changes in relative valuations. But it looks like the intangibles adding intangibles would have improved quite a bit that structural alpha. And so the conclusion from this is that book value is very likely misclassifying the value companies, and value investors should rethink the way they are defining value. So here we agreed we would take another round of Q&A.
Sure. So a couple of questions repeated have been around the length of the underperformance. 13.5 years. Is this the longest you've seen value underperform? And what does it mean in terms of typical mean reversion for value against growth? And we could also tie in, alongside the intangibles piece, are there other macro reasons? I know you talked about low interest rates. Does that mean that we'll have to wait for interest rates to go up before this mean reversion happens?
So quite a few points in that question. So let me break it down. So is this the longest? In the definition that I was focusing on so far, we're mixing the large cap and small cap value. And value in the small cap, so it's halfway in value in large cap, halfway in small cap. Now, historically, small cap value has been quite a bit stronger. Now, if we were to focus on large cap value, historically, in large cap, value actually had even stronger, longer periods of underperformance. So, for example, the B.Tech drawdown from the 90s never recovered and went into tech bubble, and that had about 14 years of underperformance. The other question, so this is not the longest by length, and that's just illustrating that value is prone to drawdowns and prolonged period of underperformance. In terms of interest rates is a very strong argument because if we were to take an analogy between equity and bonds, for example, we would see that, well, by normal kind of examination, growth companies have larger growth rates and they have cash flows further out in the future. If we're to treat that as a bond, then when discount rate, when interest rates is going down, then the value should go up. And that could be potentially one of the reasons why value underperformed in the last 13 years, as we've seen such low interest rates. Now, interestingly, when we test that hypothesis and we take the data to the 1920s, we don't see a statistically significant or economically significant relationship between either interest rate levels or interest rate changes and value versus growth performance. And so basically it's a nice narrative, but it's not confirmed by the data. We don't see supporting evidence for that. And there are some reasons why. So one, for example, is when we're looking at value versus growth companies, value companies tend to be more mature. And as they're mature companies, they tend to rely more on borrowed capital. Well, if you are looking at borrowed capital, now for a company, the interest rate becomes an expense. And so when interest rates go down, then the interest rate expenses go down. And if value companies rely more on borrowed capital, they actually benefit more from the reduction in the interest rates in terms of their costs, and costs go down and the cash flows goes up. So, and that could be one of the offsetting forces. The other offsetting force could be that growth rates is a very nice narrative, but forecasting growth, especially far out in the future, is very hard. And it's easy to take ex post narratives, but ahead of time, it's not easy actually to forecast growth far out into the future. And so what it means is that this duration difference is actually not that large. So with this, should I go into the next section and then we have Q&A in the end?
Yeah, sure. Let's finish the next section and we can take all the questions together.
Perfect. All right, I have the survey in front of me, so I assume I can minimize it.
Yes.
Of course, I think I'm not the only one who sees this survey, so I encourage everyone to complete it before you log off. So finally, in the last section, what I want to talk about is smart beta, factor investing, and the prospects for value given the current environment. So very often, research affiliates is viewed by many as the godfathers of factor investing. And the reason, and smart beta or factor investing, whatever you call it, has seen quite a bit of growth. So here's the chart which shows the amount of assets and number of funds that have gone up quite significantly over years. And Research Affiliates was one of the pioneers behind it. And what I want to communicate is that it's not the fad. Factor investing has quite strong economic underpinning. So if we were to look at the literature on fund selection, let's say very famous Carhart 1997 article, in his influential article, Mark Carhart wrote that basically it's the three biggest sources of persistence in mutual fund performance are factor exposure, transaction cost, and management fees. So basically, if you can select funds with the right factor exposure, with low transaction cost and management fees, you're very likely to pick a better performing fund. And then finally, another important piece of research is that research has documented that when we're comparing the time-weighted return of investors versus dollar-weighted return, the dollar-weighted return tend to be on average 2 percentage points lower than buy and hold time-weighted return. Why is that? Well, the answer is that the classical active investing has a promise of alpha. But how can you measure alpha? Well, the only way to reveal alpha is to look at past performance. But unfortunately, past performance is very noisy and can be dominated by styles becoming more or less expensive. And so as a result, what it leads to is it leads to investors, by focusing on historical alpha and looking for that skill, investors tend to buy what is expensive, what has outperformed recently, and sell what is cheap and what has underperformed. And so essentially the multi-factor or smart beta, again, whatever your preferred label is, the key reasons why it has attracted so much attention is that it provides exposure to robust factors, tends to be low transaction costs, low management fees, and it has simplicity and transparency, which can allow investors not to lose those 2 percentage points, because you no longer have to search for that alpha. You know the reason for outperformance and underperformance, and that can eliminate that necessity to rotate between funds. So essentially, these are the key business reasons why investors has gone for factor investing, and why we think it's not a fad. Research Affiliates' journey in factor investing started with fundamental indexation, RAFI. And the RAFI idea is very basic, very simple, where historically cap weighting has been the key way of doing the passive investing. But when we are doing cap-weighted investing, you would overweight overpriced stocks and underweight underpriced stocks. because the weight would be linked to the price. And the idea of fundamental indexation was, why don't we measure companies based on their measures of size unrelated to price, such as 5-year average adjusted sales, 5-year average cash flows, dividends plus buybacks, also 5-year average, most recent book value. When we're doing it, we're creating a lot more stable anchor, and more importantly, which is unrelated to price. Now, historically, over periods, this has resulted in about 150 basis points of per annum value add, because you would avoid the return drag of cap weighting from overweighting overpriced stocks and underweighting underpriced stocks. But look at it from a different lens. It has the value tilt, right? And value is an important factor, but it's just one of many. And that's why, for example, if we're to look at many factors tend to have periods of good performance and periods of bad performance, any factor. So for example, value kind of in the middle, then all the way at the top, then kind of can go almost all the way to the bottom. Importantly, when we, and the same is true for all factors, importantly, when we average between factors, this dark blue line bar in the middle for this 3-year period, this average multi-factor gives a lot more mid-of-the-road performance. And so this smoother ride is the key feature why multi-factor recently in factor investing has become kind of the more common vehicles. And for example, RAFI multi-factor, we have RAFI multi-factor where we're focusing on value, low volatility, quality, momentum, and size as the factors. Now, importantly, though, I think that it's still quite important for investors to consider which factors they believe in the most. So, for example, we think that value is one of the strongest ones because price matters. And because of this, I want to conclude this talk with an outlook for value. So I mentioned when talking about the return attribution that we've had a period 13 plus years of underperformance. The average underperformance was negative 5.4 per annum. But the reason why is because the valuation spread went from 22nd most expensive percentile to 100th cheapest. So here's the historical histogram of the historical relative valuations of value versus growth. And you can see that right now we are on this leftmost point. In fact, this is for March. In the last 3 months, it has gone even further to the left. But right now, value is the cheapest it's ever been. And historically, value has lived a lot more in this right territory, kind of closer to the middle of this distribution. So the interesting question to ask is, what can we say about value performance if we were to see some reversion to the historical relative valuations? Well, and here is examination of a few scenarios. So based on the changes in relative valuation. So even if we were to stay at the current percentile, so even if relative valuations were not to go more to the left, if value were not to get even cheaper, well, then we would see positive return from structural alpha. For value to be continuously underperforming, value needs to go into cheaper and cheaper territory. Importantly, if we were to see even, if we were to go all the way to halfway, we would see in the year about 65% return. So what it means is there is quite a bit of value stored in the current cheapest cheap valuations. But even, well, you could say, argue that maybe this 50th percentile is too aggressive. Well, even if we were to go to 95th or 90th percentile, value would outperform by 28 to 38% per annum. And that's a big number. And so basically the bottom line is when value became cheaper, it was painful for value investors. But what it means right now is we have not seen value as cheap as it is today in the history of observation. close to 60 years. And what it means is very likely value is an interesting opportunity. And so with this, I want to go into the final round of the Q&A.
Thanks, Vitali. So as an extension about your second section around why intangibles don't get reflected in your book value and hence the price to book tends to get understated for growth companies, what other metrics do you recommend? Whether it's price to earnings, does that have a better power in terms of predicting value, or it's EV by EBITDA, or do they also need some adjustments?
Yeah, so we think that price to book, any single measure alone is a bad measure. And I've discussed why price to book is bad. Price to book is also bad because it's more prone to give higher exposure to distressed companies. But other measures, basically all measures, price to cash flow, price to sales, price to dividend, over long enough periods, they give about the same rate of returns. None of the measures turns to be a clear winner. Each has, as a standalone measure, its own drawbacks. Let's say cash flows tends to dry down in periods like right now. And that's why it's probably a good idea to average cash flows over half of business cycle, for example, or full business cycle. Also for sales, sales tend to allocate to thin margin companies. So any measure as a standalone measure is bad. So I would recommend actually mixing a number of measures, because by mixing, we would fix the idiosyncratic, we would mitigate the idiosyncratic drawbacks from each one of them, but as a combo, they tend to be more stable, less turnover, and they tend to work pretty well across different geographies.
Right. And extending that into your third part of your presentation about smart beta has clearly taken off, and Research Affiliates has been at the forefront of the development of the smart beta asset class. In India, it's quite new, and not many funds or opportunities or strategies are available. We want to understand, given that if you were to make adjustments like capturing the value of the brand or the supply chain network, generally intangibles, to adjust for the book value, does that become a hindrance of sort for a top-down quantitative approach towards understanding value? And does that also mean the effectiveness of smart beta requires very accurate data about fundamentals to be able to index the fundamentals in the first place? And then extended that question for our audience, which is, in a typical emerging market like India, where data accuracy itself can be a question, does that suggest smart beta's efficacy in this world of very fluid data availability itself is a question mark? Sorry, a lot of questions put together. I thought they were connected,
yes.
and see if you can handle them.
Yeah, so so let me start from the start of the question, which is the intangibles and the data issues. So intangibles, intangibles are, even if we are not able to proxy for all the elements of intangibles. So for example, I showed you a backtest where we did a very, very crude way of measuring intangibles. All we did was capitalize R&D and just 1/3 of SG&A. That data, I believe, is actually very well available throughout the markets. But even this crude approach allows for pretty decent improvements to return. Now, of course, the approach could be made a lot more sophisticated and could be improved quite a bit. So, for example, looking for advertising expenses as a separate item, looking for the value of patents, looking for other proxies of brand value of a company, and finding other proxies to capitalize it would improve the measures of intangibles quite a bit. But even with this quite crude illustration, you could see that there is a benefit. And by the way, in the market environment, we will never see 100% of the money governed by multi-factor. There will always be room for active approach where somebody else will find these other signals, this niche information, would be able to benefit from it, and that's good. But where we have the big crude numbers that we could benefit from, I think that's where the multi-factor approach becomes quite powerful. And then answering your question about the quality of data. In certain aspects, the quality of data in the emerging markets is almost as bad as it is in the United States. And that's partly a joke, but partly not. There is quite a bit of manipulation in the United States, in all countries, with accounting, and so, for example, accruals and other measures. That's why they're working. But if anything, the multi-factor approach could be even more powerful in the emerging markets, because one element that we quite consistently observe across markets is that in the markets with less efficiency, we see larger potential for mispricing. And as a result, many factors work stronger. And so from that perspective, we see that value, for example, and a few other factors work a lot stronger in the emerging markets than in the developed markets. By the way, even within developed markets, when we compare large cap versus small cap, we're seeing similar kind of dispersion, where a small cap, which is less efficient, tends to work better. And when this efficiency, when this higher alpha, it could be coupled with higher transparency and low fees, I think that can bring a very strong benefit to investors. And that's why I think that factor investing has actually quite a strong potential in the developing markets.
Great. So we just have 2 minutes and just time for one last question. Seems like an oft repeated question, so I must ask this to you. Our audience is not going to go away without you telling us, when will value bottom out and when will the underperformance come? Especially one gentleman has touched upon the inflation aspect, given that this time the stimulus in the West seems to be different. It's going beyond just the financial system, taking in all the money printing. Businesses are able to get credit guarantees from the government. There's money in the hands of businesses. There's money in the hands of the consumers. And therefore, the extrapolation that finally we might see that elusive inflation in the developed world sometime next year. Could that be the trigger for value to come back and mean revert?
Yes, and we're definitely living in very historical and momentous times. The the lockdown and the damage that it has to the economy, to the global economy, is tremendous. The unemployment numbers are extreme, and the stimulus packages that various governments across the world are taking are also quite extreme. Historically, when looking at recessions, value tended to outperform quite significantly in the market recoveries from recessions. Now, we have seen so far market dropping down in February and March, and then quite significantly recovering. Now, interestingly, what we haven't seen so far yet is the resolution of uncertainty around the market, around the COVID, about the crisis, around the thing that caused the crisis. And my kind of based on the history, based on what I've seen over the history, is that value in the recoveries tends to outperform significantly when the resolution of uncertainty happens. Currently, especially when we're looking at the dispersion valuations, value is extremely cheap. And very likely value, it is value which is going to drive the prices up when the resolution of uncertainty happens. So that's where I would put most of my money in terms of that. Now, of course, the inflation concerns are there too, and they're not to be neglected. Now, of course, If governments were to do too little, we could also see deflation, and that's also a risk. So it's going to be a very thin balancing act. And so I'll leave this question at that, and we'll go to just a conclusion. So basically what I want to say in the last few remarks is value engine is surprisingly quite healthy. We've seen rates of migration on par with history, differences in profitability on par with history, but the correct definition of value is in flux. Basically, we've seen value working normally, but probably slightly worse. And probably the reason why it's slightly worse is we have some issue with mismeasurement of value. More importantly, though, the elephant in the room in terms of the values underperformance in the last 13 years has been that we've gone from 22nd most expensive percentile to 100th cheapest percentile. And so currently, value is as cheap as it's ever been, and there is quite a bit of opportunity. And in terms of accessing it, I think the costs, transparency, and diversification matters, and that's what will drive the long-term benefits of value investing. So with this, thank you very much, and it's been a great pleasure to talk to you about value.
No, thank you so much, Vitali, for sharing your insights with us today. It was super fascinating. As a reminder to our listeners, please do complete the evaluation survey. CFA Society India members may claim professional learning credit by logging in their online professional learning tracking tool. Thank you all for participating in today's webinar. Stay safe.
Thank you.